This Week in Startups is brought to you by Citrix GoToMeeting. Meeting is believing. Visit gotomeeting.com. Click the Try It Free button and sign up for a 30-day trial. And DigitalOcean. DigitalOcean is the fastest growing cloud infrastructure provider built for developers. With state-of-the-art data centers around the world, DigitalOcean is laser-focused on its mission to simplify infrastructure for development teams. Visit digitalocean.com/twist and get $10 credit to spin up a server in 55 seconds. Today, at the 2015 Draper Venture Network CEO Summit, Jason sits down with DFJ founder Tim Draper and Troy Carter, CEO and founder of Atom Factory.
That's what it's all about, man. They said, money is the root of all evil. What? Funny how it feeds my people. Yeah. We ain't gonna live like equals until we get the money, spend the money, and defeat you. Yeah. Money is the root of all evil. What? Funny how it feeds my people. Yeah. We ain't gonna live like equals until we get the money, spend the money, and defeat you.
So we've come to almost the end. This is what we call the Investor's Fireside, and we have an incredible lineup. So moderating the discussion is going to be a good friend of the network, sort of now has moderated, I think, 3 or 4 years in a row, Jason Calcanis, who many of you probably know from Launch or Inside. And so he's going to lead a really fun discussion with two investors, one of which you know very well, our very own Tim Draper, the second of which, if you don't know, you will. So Troy, heading up from LA, he was Lady Gaga's former manager. He's CEO of Atom Factory and Smash Labs down in LA, and what I call a Titan Uber angel investor in investments such as Uber and Lyft as well. So you're going to have to explain that. But without further ado, give it up for our panel.
Right.
Okay, microphone check, 1 2 1 2. Thanks for having me back. It's always great to be here, and we've got a great discussion because
That's nice. They don't always ask me back.
yeah, well, might
I
be
have
time.
to throw my own conference.
Might be time to reflect on that a little bit. So, what I want to talk to you guys about today is the sheer number of startups we're seeing, and the incubator university trend we're seeing. In the last year or two, you launched Draper University. I got to visit just 2 weeks ago. Pretty amazing. You have kids in dorm rooms coming and learning how to be entrepreneurs. And Troy, you last year at your management company decided to clear out your gym, which nobody was using, literally.
The most underutilized space in the building.
That was a gym that I went
That was a
Gym, and then you
gym.
made it into an incubator, and you had 6 or 7 really great companies there. I got to visit them as well. So why did you both choose, since you have your choice, both of you are very successful in life, you can choose to do whatever you want with your time or nothing at all, and you chose to take on the portion of the ecosystem with the highest failure rate, the nascent startups, or even pre-startup idea phase. Why did you each choose that? I'll start with you, Tim.
So we saw something happening out there. We saw the incubators and the accelerators, Boost, YC, they all started to create a new way of thinking for entrepreneurs, so that entrepreneurs would have sort of a new platform from which they could launch. So they didn't have to do everything themselves, and we could connect them with venture capitalists and do it in a much more efficient way. And I thought that it was maybe not a bad idea to come in and try to grab entrepreneurs that were sort of 18 to 28 years old and give them the emotional, physical, and intellectual challenges that they were going to have to face when starting their business. And so we just decided to create a school that was completely different from any school that you've ever seen before. And it seemed to attract, we hit a nerve because it seemed to attract a lot of students. We teach future, we have real physical survival training, we have a Tony Robbins-like Tony Robbins acolyte who inspires but also gets to the heart of each of those students. They come out, then at the end they do just what they do at Boost or wherever. They pitch a panel of venture capitalists and they go through the whole process. Our thinking there wasn't just to inspire people and create more heroes. We called it Draper University of Heroes. It was also to get people to create this new mindset that was like, hey, we can do it, we can try stuff. We don't have to be A students. A student, I think, is a mistake. I mean, putting the A just means I made no mistakes.
Yeah.
We like people to fail and fail again until they succeed. So we like to see the big vicissitudes, the big variety. And what it's done, it's been an amazing surprise as how well it's worked.
This is year 2?
This is year 4.
Year 4?
Yeah.
Wow, it goes fast.
Yeah, it does. Actually, the toughest thing we've had to do was actually working with a town to turn a beat-up old hotel into a school.
Yeah, well, there's nothing that would draw resentment from a city such as goodwill and progress.
and
right?
inspiration and
Yeah.
progress and business and all that. And it has been one of the entrepreneurs themselves have created a lot of interesting businesses. I mean, I think we've had 500 through the program. They've started 220 businesses. They've raised $40 million or something. A few of them look like they're real rockets. But the deal flow that I've gotten at Draper Associates because of this school is off the charts.
So it's the top of the funnel, which then leads to, hey, some seed investing, which then leads to some A rounds, and what a halo it builds. Troy, why did you start yours?
No, it's funny when you were just saying the failure rate. I was just thinking it's probably 1,000 failed musicians to every failed startup, right? So
You're like, failure, I did that for 20 years.
He seemed to hit a few that worked.
Yeah.
But I think on our end it was we kind of looked at Atom Factory as this place that empowers both artists and entrepreneurs. So where for years we've been sort of this accelerator program for young artists that had come through our company. They come in 18, 19 years old, basically with this dream, and our job is to accelerate that dream through our network. And in that case, it's radio stations, music labels, music publishers, concert promoters, and that global network. And once we started making investments, we learned that when you can take a young founder who's basically, great idea, great product, and put them into that sort of mature network and being able to give them access to that sort of business development, it really works. So what we saw was this sort of lack of innovation happening in the music industry, and decided to be able, to put a few companies that are going after problems in music, culture, and that ecosystem, and put them through our program.
Hey, do you cross-pollinate? Can you get Lady Gaga to write a song about, Uber?
The question would have been more appropriate 3 years ago. They had a bit of a falling out.
Maybe not Lady Gaga.
Yeah,
anyway.
exactly.
It happens with the artists.
Exactly.
That's all right. A falling out's
It happens
okay.
with Travis too, though, so it's like...
It does happen with entrepreneurs as well. It can happen. The interesting
I look
thing
at a
is-
falling out as a first step toward true love.
Yeah, exactly.
Reconciliation.
You could
I still love it.
probably pull it back together.
I still
if
love
you
it.
had to.
But I do think but to answer your question, there's the real cross-pollination is when you can take, we saw last week, another one of our portfolio companies, Lyft, did a great activation with Justin Bieber around the release of his new album. So which it did incredibly well for Justin in terms of being able to give him a bit of a competitive edge this week in selling records. And it also gave Lyft a great marketing tool to reach this audience that didn't know about the company. So it's a lot of cross-pollination.
Yes, Citrix GoToMeeting. I love this product. I use it constantly. Think about all the time, money, and hassle it takes to hold a meeting. People have to go from the peninsula up to here, back and forth, the 101, the 280, the 405, the 10. It doesn't matter where you live. There's tons of traffic, parking, nonsense. Planes are late and expensive. My recommendation is that you meet your clients and coworkers online with Citrix GoToMeeting. It is the smarter way to meet. And in fact, I just did this with 5 entrepreneurs from around the planet. I was meeting with them on a GoToMeeting, talking about how to present their companies and how to raise venture capital. It's easy to meet with your team wherever you need to, wherever you are, because GoToMeeting, you can meet from a computer, a tablet, a smartphone, no travel expenses, no hassle. Your team joins by just clicking a link. There's no sign up, there's no speed bumps. You turn on your webcam and you have HD quality. It is stunning. I literally just had 7 people show their HD video from around the globe, and it was perfect. And that's what you get when you use Citrix GoToMeeting. It's flawless. I love it. I've been using it for years. I probably do between 5 and 10 GoToMeetings a week, I would say, conservatively. And everyone gets to see what you're doing because you can switch the presenter. One person can present their product, next person can do a keynote, next person can use Reflector to show their iPhone app. It is incredible. I love it. So here's what I want you to do. I want you to sign up for a GoToMeeting today. Try it free for 30 days. There is nothing to lose. Just visit gotomeeting.com and click on the Try It Free button. Do it now, and you'll have your first meeting set up and running in minutes. That's gotomeeting.com for your free 30-day trial. And go ahead and thank at GoToMeeting on your Twitter handle. They love to see that our fans are loyal. Okay, let's get back to this great episode. Okay, let's talk a little bit about the number of companies, because the number of incubators has gone up. The amount of funding, angel investors at an all-time high, angelless syndicates playing a huge role, and this has become a truly global phenomenon. This isn't just happening here anymore. So, Tim, when you look at the sheer number of companies, when we met in the 90s, you would invest in a company every month or two, and you'd see 2 or 3, 4 or 5 companies a week. Now, it seems like it's exponentially larger. What does this mean for the ecosystem? Does it mean we're going to let me just leave it at that. What do you think this means for the ecosystem? You've seen 3 decades of this, 4 decades of this.
Well, it does come in waves, and we are at one of these waves where people said, wow, that Uber thing, it's worth $50 billion. That gets people's hearts racing and saying, hey, I can do that. Why don't I go start a business? That's generally a healthy thing. We are looking, though, at, as a company gets started, they really need to go through and check to see, like, do a Google search. Before you start a business, do a Google search. See if there are 300 companies like it or just 1 or 2.
Right.
If there are 1 or 2, you may be onto something. If there are 300, you need to redefine it or become more abstract or figure something out. And it's times like this that we have to be very good at not only filtering, but understanding competitive dynamics, because we might get 10,000 business plans in a year, and of those 10,000, what I get, I have an opportunity to probably meet with 1,000 of them.
Right.
It's about 3, 4, 5 a day, something like that. And so I meet with 1,000 of them. All those entrepreneurs are trying to show that they're bigger and better and greater, but if they've got 40 competitors, they're going to all kill each other off. So when there are a lot more businesses out there, we not only have to be pickier, but we have to be sort of pickier and looking for abstractions, because we don't want to be in that venture fratricide situation where all these little companies are killing each other off before something emerges. But the markets are getting bigger. There are more people on the web. Companies are going to grow faster than ever before. The venture capital business is sort of the best place to put your assets because we capitalize on change. If things are changing faster and faster and faster, then the status quo is not a good bet. And we're seeing huge change happening, and that's fantastic. I love that. It's just dynamic. I love that the big monopolies and bureaucracies are being challenged by these little startups who are coming in.
In a way that they typically did not. They really felt like they had 6, 7, 8 years to deal with these rising startups. So it's like, yeah, we'll just monitor them. Now it's like, by the time they find out about them, they've run over them. Troy, how do you pick companies for your incubator? You've done 1 or 2 classes now? Or this is the first?
We just did our first demo day yesterday,
But Troy has been a great angel investor. He's in some amazing companies. Yeah. So this is just the first of his.
Yeah.
Just make that clear. This guy's awesome.
For us, it's where Tim is, seeing every single wave. We've been investing for about close to 5 years now. So we weren't around, and I was making hip hop albums in 1999 when you guys' world was falling apart. During that first bubble, and I just read about it, so I didn't live through it. So just from my lens and the seat that I sit in right now, it's definitely a lot of companies, right? A ton of money in the marketplace. Definitely feels a little bit broken on the back end, for sure.
What does that mean on the back end? Feels a little broken.
I just think late stage right now, is and all companies aren't created equal, by the way.
Right.
So I think Uber deserves a $70 billion valuation or whatever the valuation is today. But there are a lot of companies out there that I don't feel like has earned that unicorn status, just for different reasons for different companies. And also, I think what I see just on the early stage side is everybody isn't built to be a founder as well. But it really reminds me of real estate 6, 7 years ago, when all of a sudden your cousin became an appraiser, this guy got the real estate license.
Yeah.
Exactly.
Speculators.
It was a lot of speculators, and everybody rushed to the market. And to Tim's point, you read about Uber being a 50, 60, 70 billion dollar company, and everybody kind of rushes into the space. So I'm just being very mindful on our end. We're still active, and I'm still seeing a lot of really great companies with a lot of great potential. In the meantime, I definitely think as an asset class, if we're looking out at the next 10, 20 years, every company is going to be a technology company. So it's definitely a class that you're going to have to be in for sure.
So I actually think it's broken in a different way, and it does bring me back to 2001 to 2008, where it would have been fine, actually, during that period if we hadn't been hit with Sarbanes-Oxley in 2004, which made it almost impossible for these small businesses to go public. And going public was a way for companies to just keep being run by the entrepreneur and run for the long haul and building their value and giving liquidity to all the investors. And during that time, all of the bigger companies were afraid to buy anything. So they were scared.
It's quite a logjam.
Yeah.
And it also creates a trickle-down effect, right? Where you can't...
Well, it also killed companies. There were companies that went from 10 to 20 to 50 million in revenue, should have been worth $1 billion, and then they'd try to go public, and that would waste $4 or $5 million of their profits, and and then they couldn't get out, they couldn't get public, and then there was all the people who worked there said, oh, well, maybe this isn't where I really belong.
The dream's over,
and then they started to
unravel.
And, so it went from 50 to 49 to 20 and down. So I think there's some really healthy things happening this time around.
Yeah.
One is that the PE business has picked up a lot of the opportunities. They come in and they say, and Fidelity going direct instead of waiting for a banker to anoint it. They just sort of go direct in and they buy a big piece of the company. But I think that there are these other things happening. New technologies like their electronic shares. I think you should all, by the way, be using either eShares or CapShare out there. It's really making our lives much easier, and you can trade shares.
To move money around, secondary?
Yeah. Well, first of all, everybody knows who owns what. That's always a good thing.
Yeah, I noticed. I'm sorry to get phone calls about a couple of my holdings. Yeah.
Right. And then ultimately, maybe they become tradable. And then there's AngelList and Funders Club and Crowdfunder. They all have this way of connecting the entrepreneur to venture angels and eventually to venture capitalists and on up the food chain. And they're all going to be potentially, they may be an exchange down the road. And then I think that maybe these secondary markets might come out. We had a real problem with liquidity in the private markets, and I think this time around with, there's a little bit of progress from the government. There are a lot of progress from some of these
Seems
startups.
like the SEC is begrudgingly approving some of these measures. They just do not want the headache.
They're making it hard for it to happen, but
yeah, I looked at it and I was
they do realize that they have to do something because that really did kill huge economic value.
Hey everybody, I want to tell you about DigitalOcean, the best place for you to deploy your new application. It's super easy. It takes just 55 seconds to launch on an SSD drive in the cloud. Super fast, super easy. And hey, listen, they've got 550,000 developers using their product because it starts at just $5 a month. It's super easy to use, and the API is super slick. What more can I tell you about it? I mean, you can go and have a pre-configured one-click image of Node.js, Magento, or Docker, or you can do your own custom infrastructure. Pick what you want, obviously. Their clients include TaskRabbit, Universe.com, Flywheel, Compose, and us here at This Week in Startups. And with hourly pricing, you only pay for the resources you actually use, and you're going to get one clean bill. Go ahead and visit DigitalOcean.com/twist, DigitalOcean.com/twist for a $10 credit. And it's really full circle for us here at This Week in Startups because the CMO, Mitch, was a guest caller on This Week in Startups. And he asked me, Jason, what should I do with my career? And I said, join a high-growth startup. And he did, and he co-founded DigitalOcean. And now DigitalOcean has received tons of venture capital from people like Andreessen Horowitz, et cetera. And now they're a partner here on This Week in Startups, and we use their product. How full circle is that? The only thing that hasn't happened here is I haven't invested in the company yet. That's what's killing me. I'm reading this ad going, oh my God, I need to angel invest in this company. Anyway, listen, DigitalOcean's amazing. We use it. We love it. Any product that you hear me talk about, we only allow products to do a live read like this if we actually use them and love them here at This Week in Startups and myself. So that's the case certainly with DigitalOcean. We love the product. Go ahead and visit DigitalOcean.com/twist and get a $10 credit and thank DigitalOcean on your Twitter handle. They're at DigitalOcean. Go follow them. They love to hear from that. And when I see a super fan do that, I always go and give a fist bump and heart it and star it on Twitter. And I personally really appreciate it when you thank the sponsors because they love to hear that our fans are so loyal. Okay, speaking of loyalty, let's get back to this amazing episode. Where are you having the most challenge with your startups, Troy? One of the things I see as an angel investor is, especially when you become super angels category where people know you can write a $250, $500K check, $750K check, like I guess you and I both can do now. The young startups keep coming back to you for that next 250, 500, but you can really only do that once or twice.
Yeah.
Are you seeing the same Series A crunch, people called it before, but just it's hard to get a venture capitalist attention today because they keep raising the benchmark. The VCs have more deal flow, and the deals are getting better, and so they're turning down people with $1 million in annual run rate.
Yeah.
They're turning down people with 10% month-over-month growth because they have somebody with $2 million and 20% growth. Do you see that same trend?
Yeah, we've been seeing it too, and
it's crazy.
Yeah,
it's making me crazy that a company just 12 months ago. I'm sorry to make it about me. Yeah. A company 12 months ago that would have, been able to find a great venture partner to do a Series A cannot find it now because my VC friends say, well, I've got 4 things, Jason. What am I supposed to do? I can't take on 4 kids at once.
Go to Draper Associates.
There you go.
We fit right in there.
Okay.
Nice. So
Well,
now I know where to send them.
Exactly.
Now I know
Go
where
see
to send
Uncle
them.
Tim. So you're seeing the same thing. How are you dealing with it?
You know
What's
what?
the dialogue right now?
No, and for us, it's like, where I think we've done incredibly well by staying incredibly disciplined and kind of knowing where we sit in the food chain, how big our check needs to be, where we can be helpful, and also the importance of having a very strong syndicate around, right? So, and I think the syndicate in the very beginning kind of served as really great training wheels for me, and also having guys like you in a deal, guys like Shervin in a deal, guys like Mark Suster, and having all of those people around any given deal and any given entrepreneur was a really good education. So even now, we're still very mindful of not being the biggest check in the seed round. So if it's $1 million seed round, we're probably 250 of that seed round.
You're
right?
hoping somebody else is 500.
Yeah, exactly. And for us, that's just been a great strategy. And we'll still have pro rata or super pro rata, moving forward or whatever. But just really understanding where our check sits in that space.
And you have to communicate that to the entrepreneur so they understand exactly what's going to happen in 12 months if they come back to you.
Exactly.
Talk a little bit about pro rata, super pro rata, and these kind of examples, and why that's important should be obvious. But what's your experience with it so far? Have you been doing pro rata as you keep going? And then when you say syndicate, do you mean AngelList syndicate or doing your own syndicate of people that you curate off AngelList?
Our own syndicate.
Okay.
So
how does that work?
So in terms of with the first question, that was one of the things going from investing off of Adam Factory's balance sheet, which I'm the only LP, and then, which I did for 4 years, and then kind of moving into a more institutionalized fund. The idea was, one of the big learnings was definitely, being able to keep as much, maintain that ownership moving forward, and just seeing this hyper growth of these companies, it's very difficult to invest off of your company's balance sheet, keep the company healthy, and still exercise pro rata rights. So being able
to get pretty big pretty quick.
Very, very quickly. So being able to have a separate fund to be able to do that out of was important. And then the second question in terms of the syndicate, having. And this was the beauty of being able to be in LA and have, because the way our company's set up, we built this company to accelerate the artists. And so I had a marketing division, social media division, brand development, advertising agency, video content, all of these different divisions to support artists that also became very helpful to entrepreneurs. So we became this differentiated capital and very complementary capital. So our 250 was very different from another 250 that would be coming in the deal.
Why is that important?
Because if you're an entrepreneur and you're figuring out, okay, I have a $250,000 allocation left, and I can give it to this guy, this guy, this guy, or this guy, because everybody has a checkbook right now, but the 250 right here, wow, all of a sudden I have access to, these Fortune 100 companies. I got access to somebody who understands communications, has great press relationships. They understand influencers. They have all of these other things. And this 250 right here just has the same exact thing that my lead investor has and all of these other people have or whatever. I'm giving this allocation to this person. So it was, so for us, it was great because we started getting a lot of calls from, some of the bigger VCs who said, hey, there's a little bit open in this round right now. You should meet with this entrepreneur. And then it turned into the entrepreneurs just kind of carving out allocations for us.
Tim, you love to fuck around with platforms and how things are done. You got your 17 different sections of California tie. 1600 Californias, whatever it is.
I like that.
All these different things. And also what you did with your, you were like kind of the original venture syndicate when you took DFJ.
Yeah, the network.
The network, all this kind of stuff.
Network has been really good for entrepreneurs.
What will investing at this early and mid stage look like in your mind 10 years from now? Where could it end up? Because when we talked about syndicates just 3 years ago, and we all launched them, I think maybe it's 30 months ago or 24 months ago, there was a big, never gonna happen, amateur hour. And now,
now it's a big deal.
Yeah, now it's kind of like, I have people coming to me saying, I talked to these 4 venture capitalists, and we'd like you to lead the round, not them. And we'd like to have them fill in and you lead it, or Gil Pincina, or Tim Ferriss doing $1 million rounds. Take us to 10 years forward, you're pretty good at this, 10, 20, 25, what could it look like? Not what it will look like, what could it look like? What are the possibilities?
Because there are regulators who are trying to keep the status quo, but let's assume we can
kick them out, buy them off, whatever.
Move progress along. So
it's working so far. Megan Smith's over there.
So I actually think that we're going to go into a really fun period where the entrepreneur will be getting money from a venture capitalist in the form of Bitcoin. It will go on a blockchain, a smart contract on a blockchain, and the entrepreneur will then spend the money as Bitcoin. And what will happen there is it will be completely transparent. Wow. The entire contract will be transparent, and if it's all done in a smart contract, when the company is sold, boom, immediately everybody's Bitcoin wallet is filled. And this, when you go look at the Star Wars movie, and there's 15 minutes of credits that go through there. Yeah. Each of those guys gets $1.25. They get a check in the mail for $1.25, maybe once a quarter or once a year or whatever. I'm sure you've gotten a few of these.
Exactly.
You get it, and what do you do with it? You put it up on your wall or whatever. But
I cash
but it
mine.
Costs them.
He takes a picture and cashes it, then he puts the picture on the wall.
Mine were for like 32 cents. Anyway, it costs them $7 every time they send out an envelope like that. And they're sending out it's costing them $7 to send me a check for 32 cents. Mm-hmm. And it would be so much easier to just go, boom, put it into the Bitcoin wallet and it'll be done. Now, here are the other things that I think are going to happen. I think since governments are going to have to compete with each other, I think we're going to see governments become more virtual. There's no reason that you can't use just one computer that takes all of the roles of 700 bureaucrats. And the computer would be fairer to all of us and more consistent, and all of those bureaucrats can go do things that are much more proactive and build a better economy, get us to the moon, whatever they're going to do. So I think there are a couple of interesting things that are going to happen over the next 10 years, and one sort of falls into the fintech category, one falls into the GovTech category, and I like them both. So yeah. I'm looking for those. Yeah,
they're big, audacious, and hard, so it's a good thing to work on. Troy, when you look at your portfolio of up-and-coming companies, which two, not three, not one, two, do you think you are the most excited about right now, and the people in the audience should most meet with at this stage in the company's lifespan? People who can write here, I believe, A and B and C round checks, correct? Mm-hmm. So who do you love?
One that stands out right away is Meredith Perry at uBeam. If she gets this right, she is basically wireless charging technology. So,
uBeam.
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 Yes.
And now this is one that's been under speculation that it could be fugazi, or hey, it's too good to be true.
Everybody thinks
It's,
the
it's anywhere in the room, right?
Exactly.
You don't need to put it on a pad.
Got to be line of sight though.
Yeah, and but it's one of those you get it
does
right.
I don't think it does.
Does it?
It doesn't have to be line of sight,
Say it
does it?
again. Oh no, not
It can bounce off the
Yeah,
walls
okay.
and go around people.
Correct.
Okay.
Correct.
Have you seen it?
Yes, I've seen it, and it could work.
Yeah.
It could really work, and she already has some great partnerships lined up. But it's one of those. It's a moonshot,
Right.
You know, and so in terms of potential to, if Meredith gets it right, you know, it's a $50 billion opportunity versus, you know, a few $100 million. So it's a swing for the fences sort of technology.
Got it.
And, you know, I just saw the CEO of Samsung basically said, you know, so I saw him at a digital panel for the NBA, and they said, you know, what are you most excited about? And his first answer, he said, when wireless charging comes along, it's going to transform our business. It's going to transform our lives. You know, so everybody's looking at that as the biggest opportunity. So I think it's a huge opportunity there. And there's another company that we're excited about, and that's another moonshot, is a company called Tuition.io. And with those, they started off as a student debt management platform. And, you know, literally within 18 months, you know, they have a couple of $1 billion worth of student debt on the platform that they're managing. But they created a product called Flex 365 that they just opened up for employers, where from their research, they saw that millennials, a lot of these, you know, mature systems, like, you know, I think their first company is an insurance company with 45,000 employees, and with this new workforce, they've had a terrible time at employee retention. So alongside of the 401k, they decided that we're going to match your student debt.
Whoa.
And help you pay down your student debt. So dollar for dollar. So there's a huge opportunity there, and they've gone out. I think they just signed up 10 of the biggest employers in the country right now for this product. But, you know, but they need in order for this to scale, you need to have the tax benefit as well, just like 401ks. You know,
Got to come out of pre-tax dollars, hopefully.
Exactly. So that's one of the things that they're lobbying for, but it's one of those other things with a huge opportunity.
Let's take one question from the audience. If you could come up with a great question, concise, say it nice and loud. I can barely see you guys, so raise your hand if you want to ask a brilliant question. Tell us who you are, where you're from, and give us a concise, great question. Obviously, we've answered every possible question. Everybody's totally...
Oh, somebody scratched his head over here.
Yeah, I think it's tired. Wow, look at this group, huh?
At Draper University, we just call people.
Then I get the... oh, somebody's over there? Okay, go ahead. Stand up, scream your name and company or where you're from, and then the question. Cash, okay.
K-A-S-H.
Yeah, I know that.
Yeah.
So my question is this. When companies like Zenefits took money from mutual funds and then saw 6 months later the mutual fund write down the value of the investment, what would you advise entrepreneurs in dealing with non-VC institutional investors?
Great question. So the question...
A, B, or C rounds.
Yeah, so the question is, just to repeat for the cameras and for the audience I couldn't hear, Fidelity invests in Zenefits, $4.5 billion round. Then they write it down, I don't know how much, half or 25%. What should entrepreneurs know about working with those non-VC, let's call them not discrete, hyper-transparent organizations?
Well, I think...
Is it a big deal either?
Well, I think what's really interesting is that the world is getting more and more transparent, and as it gets more transparent, all companies become public pretty quickly. You know, Theranos, you know, became public just by launching a product.
Yeah.
And suddenly, I mean, the world knew all about it. It's just that the SEC hasn't figured out that they need to lighten up.
Yeah.
They need to let these private companies be tradable. I think what Kaz's getting at is that we've got when Fidelity comes in, they will very much respond to the press saying, "Oh, it's a unicorn now. The unicorns are worth half what they were before, just because the press has written about them as a negative thing."
It felt a little weird.
Then next year they'll be worth twice as much because the press will write a positive thing about these unicorns, or they'll call them Pegasus, or they'll call them something else. It's like the unicorn now can fly, and then everybody will go, "Oh, I got to be in a Pegasus," and then Fidelity will double that price. What I would do as a entrepreneur running a business is just never count your money. Never think about your stock price. Just keep driving your business. Raise money when you can, spend it when you must.
Focus on the core.
And just keep driving your business. And don't worry about if somebody values you up here, terrific. But when they value you down here, still terrific. I'll tell you one thing that's happened to us. I know that companies coming out of YC are coming out thinking that they can take over the world, and they get a huge valuation out of YC, and that's day one. And hey, I'm worth $12 million. I just started this company, and
we've got 8 weeks of Facebook ads we've bought.
We're Uber and Theranos and something else combined, and then they go and they run their business, and then they run out of cash, and then they go for their next round. And most of us will go, "Well, sorry, you're already valued way too high. We're going to depress your stock. You're going to be pissed at us." And
it's just an ugly
besides,
situation.
Everybody in your company thought that they were millionaires, and now they're not, and they're going to leave and be depressed, and you're going to have a crummy business.
So be careful about valuations.
So it's probably better to value it fairly at every round and always have an upward momentum. So you set the expectations low, you start moving higher. And,
better to have
and
an
then
up round
everybody
every time.
goes, "Yeah, this thing is going great." And there's momentum, and we want all the engineers go, "Wow, that thing's going up. I want to be a part of it."
Yeah, try.
Now, people forget how much was Uber when you invested?
It was like the $4 or $5 million seed round.
No, that's my point. People forget that. So people see the explosive number on the back end, but in terms of where this company started, experienced founders, all of the things that would make you right now, those guys, it would be a $20 million pre-money valuation.
200 compared to some.
As they're sketching it out on paper,
right.
when you compare it to what's happening now. Because I've seen a ton of companies, even out of this last YC class that we looked at, and just where the valuations just were, we couldn't
meet with
even
10
look at.
I set a goal of meeting 10 of every YC companies, and I've done it the last 3 or 4 classes and passed on all of them. And then I had something happen in the last 2 classes, which was people came back to me 3-6 months later, and they said, "Hey, can we check in?" I said, "Of course, love to check in." I said, "How did your, $1.5 million raise on a $10 million cap go?" And they said, "Well, we had 250,000. I said, "Oh, so you closed 250 of it?" They said, No, we had that soft circle." I said, "How much did you close?" "Oh, we closed 75. I'm like, "Do you think you priced it wrong?" And they're like, "Yeah." I'm like, "Okay." In fact, I had one company come to me and say, I thought it was promising, but I said, "Listen, I got to be frank with you. I invested in the first round of Thumbtack and Uber, and that was a $9 million valuation." He goes, "Well, we're only asking for 10. It's one more." I said, "I didn't finish my sentence. It was $9 million combined for the 2 companies, 5 and 4. You're asking for more than both those companies, and you're not even close to the experience level of those founders, nor the performance." And that company wound up not raising money.
Yeah.
It's pretty.
So there is a depression that happens too, and some entrepreneurs can get through that. They can raise money at a high price, raise money at a low price, and keep the business going. Most entrepreneurs, that's death. That's the end.
Elon Musk
I mean, the best entrepreneurs
had every
really
single
are,
one go up. Every round of every
Yeah.
company's ever done, he told me, we were talking about it, and he purposely did exactly what you're saying, which is manage the expectation each time. But from Zip2 to PayPal and the other two companies, obviously, that you backed, SpaceX, et cetera, everyone up round all
Yeah.
the way.
It's good to know.
What's the, you did okay on those, by the way. I don't know if you
They're-
checked.
Yeah. Well, we just keep
Jervison's,
driving the business,
Jervison's
and
earning
then
his J.
all those things are going to start working out.
Let's talk a little bit about the core traits of founders today. What do you see lacking today that you wish, God, you could increase in these young entrepreneurs? Is there something today, Troy, that you see and you say, God, I wish I could wave a magic wand and have these companies, these founders increase this piece of the puzzle?
You know what? I think the one thing for me that I would say is, and this is just personal for me, you know, I just think a healthy dose of paranoia is good.
Yes.
Like, you
Why?
know, so because I think, you know, a lot of people walk in overconfident and without, and I think, by the way, 20 years ago, somebody probably would have said the same thing about me.
Sure.
But once you live through cycles and experience and things like that, so it's being able to figure out that line that's as thin as dental floss, where you're confident, you're optimistic, you have a sense of knowingness about, you know, this path that you're getting ready to go down or trail you're about to blaze, but just with a healthy dose of paranoia, you know. That's the one thing
People are not looking over their shoulders. They're not considering what could go wrong.
Yes.
And they're not prepared for it in a lot of cases. So they get down to, I don't know if you've had this phone call, but I've had it a couple of times. Hey, we need to raise more money. I said, great. How many months do you have left? And they say 0.
Yeah, I had one of those this week.
And you're like, wait a second.
We'll be out of money
Tuesday.
in 2 weeks.
How do you call me with, I had somebody call me. I said, when are you going to be out of money? They said 2 weeks ago.
Yeah.
I said, what's going on? He said, well, not taking salaries or anything. I was like, oh, you know, you kind of got to let us know 3 months ago about that so you can make a proper plan. Nothing's worse than coming to a VC with 0 in the bank, correct?
Yeah, we don't want to take on your problem.
Right,
We want
catch
to
my
make sure.
knife.
Yeah.
What would you say that in today's group, especially now that you're running the university, got all these kids in that dorm and everything, what do you see in them today that, like, hey, you need to really work on this character trait and or approach to entrepreneurship?
Well, that group is quite extraordinary to start with, so it's a little tough to.
They're self-selecting.
They're self-selecting, and they're really quite extraordinary. The things we have to get them to be is just have the confidence and the dedication and the willingness to sacrifice their own life for this business.
So courage.
Yeah. So courage is one. What I avoid now during hot times like this are people who are kind of, they catch the newest fashion because that fashion will come and then go. I'm kind of looking for somebody who never really cared of what whether they had a soul patch or a thing here or whatever. I'm kind of looking for.
It's called a mohawk, Tim. Yeah.
No,
you mean the knot?
no, this
The
one,
knot?
the one that kind of comes
yeah,
together.
I got you. All right.
Yeah. I'm not looking for, and we get a lot of those because because in times like this, because
Chasing
they
a trend.
think the hot thing to do is to say, I'm an entrepreneur.
Right.
So
Uber for X.
I'm going to go, instead of somebody who goes, and it's pretty easy to filter these. I just ask, why are you doing this? With that kind of a message. And then they give me either they're a little embarrassed. And if they're embarrassed, I know that this is not right. Or it just bursts out of their chest. Because my last company did it all wrong, we have the customer really wants this, and they're just doing it this way. Or we're turning the industry upside down. This is going to be awesome. Those are the people I'm looking for.
Yeah, the difficult ones in some way.
Like
the shitstarters.
Like the ones out here.
Yeah. How do you manage the fact that in order to be that person, sometimes you have to be, or frequently are, extremely difficult to get along with and or have sharp elbows. Troy, you see this probably in your portfolio a little bit. How do you deal with the people who maybe are a little unmanageable? And
our company, we manage pop stars for a living.
Yeah.
So
right.
these guys,
So this is it easier or more difficult?
wait, not even close.
So the rider for
not even close.
the rider for a unicorn CEO
Yeah.
compared to the rider for a top 10 artist, a little bit different.
Yeah, a lot different. You know, you're not getting the 2 o'clock in the morning phone calls bailing people out of jail or having to beg somebody to get on the flight or sober up, or, you know, so it's a totally different, you know. The thing
Or
too,
sober up.
yeah.
Tim's had to make that call.
No, when the day I got to call
Board
an
meeting
entrepreneur
tomorrow.
and tell him to sober up, we got a real.
We got a
got
board
real-
meeting in
That's
3
the
hours.
last check you're right to that guy.
Exactly.
So, let me ask you about Theranos. You were an early investor.
Yep.
Okay, some people are out
My
there.
daughter's best friend.
Okay,
And
so
she
you're
dropped out of Stanford. She said, I'm going to change medicine as we know it.
okay. So there's a group of people out there who say it's a complete fraud. There's a group of people who say give it more time. What does Tim Draper say?
Oh, this is going to be one of the great companies of the world.
Okay.
No question in my mind. It's pretty interesting. There's a one specific writer who wants some sort of a Pulitzer Prize or something by taking down one of the unicorns. So he's got it as his mission, but he's got basically nothing to go on because this company is really transforming the world. They're making it, right now you've got vampires taking blood out of your arm to run all of these tests, and it's like a quart of blood comes out of your arm when you run 3-4 tests. Well, this is going to be 50 tests from 2 drops of blood on one little microfluidic chip. That is transforming
How close are they to
blood
having
testing.
that? Because that's the
It
big
works.
issue.
It works. The FDA has approved one test, which
Okay.
is the herpes test.
Yeah, which seems to be the easiest of the cohort, or the more easier one to do, right?
It was the first one. I don't
Got
know
it.
whether it was
Okay.
the easiest. I think it was probably the best market.
Ah,
People probably want to know that.
yeah, it's pretty
Pretty
important
quickly, right?
information.
So they've got, and here's the thing. The reason it is flourishing in Arizona is that Arizona has allowed people to test their own blood. And the other states are coming along and figuring out that, hey, it's just a pinprick. It's just like what you would do if you were a diabetic. It's a pinprick, and you run it into you run
that's
it into
that's
these
the
tests,
vision, yeah.
And it runs 50 tests, and it is extraordinary. And this company is going to be one of the greatest companies on the earth.
So, what did they get? And I'll just ask this one more question. What did they get wrong, maybe, in terms of transparency and communicating to the either investment community, the public, the FDA, and the press? Because it does seem like, from what I've read, and hey, listen, I'm reading journalists. This is secondhand information taken, hopefully, from some on-the-record people. Some of the tests were wrong, and hey, they won't let people see the technology. There's a huge lack of transparency that they say is to protect their IP. uBeam, I believe, the reason uBeam has been so transparent right now is I think they felt like they were going to fall into the Theranos trap of, hey, if we don't put this information out there. So why don't you answer that?
We actually had that conversation.
You did?
It was exactly that conversation.
Of let's not get Theranos by the press.
Well, this was interesting because Theranos basically built this company under a dome of silence.
For sure. The investors haven't seen the tech.
I was sworn to secrecy on everything I did.
But you saw the tech.
Yeah.
You've been up close and personal with it.
Yeah, but not all of it. I mean,
Yeah.
she's done a lot of things just on her own. But that was like 10 years. And she was building a company that was launched. The moment it launched to the public, it was already worth billions of dollars. It was already, many, tens of millions, if not hundreds of millions in sales. The press feels like they were blindsided. And I think what happened was this is their reaction. You know, if you try to hold anything back from us, we're coming after you. And what's great is since she's been attacked, business has been booming in Arizona.
Really? So more people are finding out about it?
Spell my name right. You know,
yeah.
It's working just beautifully. So
all right, well,
maybe she's, you know, just that smart.
There we go. All right, well, this is going to be great to check back in a couple of years on it. What an incredible, transparent, and insightful discussion. Let's hear it for Tim and Troy Carter.
And Jason.
See you. Thanks, Jason.
My pleasure.
Great.
Great job.